The headlines are screaming a victory, a massive jaw-dropping 3,620% surge in the Shiba Inu burn rate. It sounds like the supply shock we've all been waiting for. But what if that number is a dangerous trick? What if the actual tokens destroyed are so few that the percentage is completely meaningless? Analysts are dropping their alerts. Whales are moving silently. But what am I even talking about? Well, let me explain. Welcome to Dr. Crypto, your daily serving of Shiba. This is the spot for you if you're curious about anything related to Shiba. If you want to keep informed about all the latest news forecasts and stay ahead of the crypto industry, subscribe. To get more SHIB news, be sure to click the like button. Please note that by the time you see this video, some rates may have changed. Financial advice is not included in this video. The concept of the token burn is the single most critical component of the Shiba Inu investment thesis. With a circulating supply of approximately 589 trillion tokens, the path to a significant price increase is not solely dependent on demand, but fundamentally on scarcity created by supply reduction. The community's focus on the burn rate is a direct reflection of this tokenomic reality. The burn mechanism, primarily facilitated through the Shibarium Layer 2 solution and community-driven initiatives, is designed to permanently remove tokens from circulation, theoretically increasing the value of the remaining supply. The official tracker has become the daily pulse check for the entire SHIB army, with every percentage change scrutinized by millions of holders. The problem, however, lies in the interpretation of the data. The burn rate is often reported as a percentage change over the previous 24-hour period. When the burn rate is near zero, even a small, isolated transaction can trigger a massive four-figure percentage increase, creating a misleading sense of momentum. This matters because the community sentiment is highly reactive to these figures. A headline proclaiming a 3,620% surge can generate a wave of buying pressure and false hope, distracting from the much more important metric, the absolute number of tokens destroyed and the overall impact on the total circulating supply. This script will dissect the recent surge to expose the dangerous mathematical trick at play and refocus the narrative on what truly matters for Shiba Inu's long-term value proposition. The event that sparked this latest round of misleading headlines occurred on December 17, 2025. According to reports and confirmed by the burn tracker, the Shiba Inu burn rate experienced a staggering 3,620% surge in a 24-hour period. This massive percentage increase was immediately picked up by crypto news aggregators and social media channels, leading to a flurry of excitement. However, the critical detail, often buried in the fine print, is the absolute number of tokens that were actually destroyed. The total burn for that 24-hour period amounted to a mere 715,893 Shiba Inu tokens. This figure represents a dramatic increase from the previous day's burn, which was reported to be as low as 19,243 tokens. The mathematical reality is that the 3,620% surge is a direct result of the extremely low base from which the calculation began. The event was not a massive coordinated effort to destroy billions of tokens, but rather a small handful of transactions that, when compared to a near-zero baseline, produced a statistically sensational, yet fundamentally insignificant percentage. The event update is therefore not about a successful burn, but about a successful piece of statistical trickery that highlights the volatility and often misleading nature of reporting on tokenomics when the absolute numbers are not given equal weight to the percentage change. Despite the sensational headline of a 3,620% burn rate surge, the market's reaction was a resounding silence, a clear indication that professional traders and algorithmic bots are not fooled by the percentage trick. Shiba Inu's price, which is currently trading at approximately 7,423 units, showed no measurable positive movement in the hours following the burn announcement. The 24-hour trading volume, which sits at around $130 million, remained within its expected range, failing to see the spike that would accompany a genuinely bullish tokenomic event. The market capitalization, holding steady at approximately $4.4 billion, also reflected the lack of impact. This disconnect between the headline and the price action is the most telling part of the story. In a truly deflationary event, where a significant portion of the supply is removed, the price should react positively due to the immediate increase in scarcity. However, the destruction of 715,893 tokens, while technically a burn, is mathematically negligible when compared to the 589 trillion tokens in circulation. The market understands that a burn of this size does not fundamentally alter the supply-demand equation. As a result, the price remains subject to broader market forces, such as Bitcoin's consolidation and the lingering effects of recent whale movements, rather than the internal tokenomic news. The lack of a positive price reaction serves as a crucial lesson. In the world of Shiba Inu, absolute numbers trump sensational percentages. The technical evidence confirms the insignificance of the 715,890 three-token burn. To put this number into perspective, we must look at the total circulating supply. With 589 trillion Shiba Inu tokens in circulation, the destruction of 715,893 tokens represents a reduction of 0.000000000001215% of the total supply. This is a number so small, it is functionally zero. The technical analysis of the burn rate is centered on the base effect. The 3,620% figure is calculated by dividing the 715,893 tokens burned by the previous day's burn of 19,243 tokens, and then multiplying by 100. When the denominator is extremely small, even a minor increase in the numerator will result in a massive percentage. This is a common statistical phenomenon, but in the context of tokenomics, it is a dangerous misrepresentation. Furthermore, on-chain data shows that the burn transactions were not the result of a large single-source burn from a utility like Shibarium, but rather a collection of small, community-driven transactions. The burn wallet address shows a consistent pattern of small, sporadic burns, which is the opposite of the sustained, high-volume burns required to make a dent in the supply. The technical evidence points to a clear conclusion. The burn rate percentage is a vanity metric, and the only figure that matters is the total number of tokens destroyed, which, in this case, is far too low to have any meaningful impact on the token's scarcity or price. Analysts have been vocal in their assessment of this misleading statistic, labeling it a classic example of how to manipulate a narrative with a technically correct but contextually false number. The primary implication is the creation of false hope within the retail community. As noted by analysts, the focus on a four-figure percentage surge distracts from the fundamental need for the Shibarium ecosystem to generate utility-driven burns at a scale of billions, or even trillions, of tokens per day. The danger lies in the community becoming complacent, believing that the burn mechanism is working effectively, when in reality, the current rate would take hundreds of thousands of years to significantly reduce the supply. Expert commentary suggests that the true metric to watch is the burn velocity generated by Shibarium's transaction fees. The current burn mechanism is designed to take a portion of the gas fees from Shibarium transactions and convert them into Shiba Inu tokens for burning. Therefore, the health of the burn rate is directly tied to the adoption and usage of the Shibarium network. If Shibarium's daily transaction volume is low, the burn rate will remain negligible, regardless of any short-term, community-driven spikes. The analysis concludes that while the 3,620% surge is a great headline, it is a poor indicator of the token's health. The implication is that the community needs to shift its focus from celebrating small, percentage-driven spikes to demanding and supporting the utility that will generate the necessary, massive, and sustained burns. The Shiba Inu community's reaction was split, perfectly illustrating the divide between emotional retail investors and more sober, tokenomics-aware members. On social media platforms, the initial reaction was one of celebration, with many users sharing the 3,620% figure as proof of the token's deflationary success. The SHIBARMY hashtag saw a temporary surge in posts praising the massive burn. However, a counter-narrative quickly emerged from more seasoned community members and tokenomics experts. Discussions focused on the mathematical reality, with users posting calculations to demonstrate the negligible impact of the 715K burn on the total supply. Developer reaction, while not directly addressing the 3,620% figure, has consistently emphasized the long-term utility-driven nature of the burn. Core developers have repeatedly stated that the burn rate will naturally increase as Shibarium adoption grows, implicitly downplaying the significance of manual or sporadic community burns. This subtle developer stance suggests an awareness of the misleading nature of the percentage-based reporting. Community trackers show that while the sentiment index saw a temporary spike, it quickly normalized as the market failed to react. The overall reaction underscores a critical challenge for the Shiba Inu project, managing the community's expectations and educating them to look beyond sensational headlines toward the fundamental, long-term tokenomic drivers. The forecast for the Shiba Inu burn rate is one of continued volatility in the short term, with the potential for more misleading, high-percentage spikes from a low base. For the next 1 week to 1 month, investors should expect the burn rate to fluctuate wildly, with any small burn transaction capable of generating a sensational headline. The key short-term watch point is the base burn rate, the average number of tokens burned per day excluding the percentage change. If this base rate can consistently climb into the billions, it would signal a genuine increase in Shibarium usage. The current price action, still hovering around the 750 unit mark, will remain unaffected by burns in the millions. For the long term, spanning 3 months to 3 years, the forecast is entirely dependent on the success of the Shibarium ecosystem. Analysts note that the only way for Shiba Inu to achieve a meaningful supply reduction is for the Shibarium burn mechanism to scale up to the point where it is destroying trillions of tokens annually. Long-term price predictions, which often factor in a significant supply reduction, are predicated on this scaling. Investors should watch for a sustained increase in the number of daily transactions on Shibarium and a clear, transparent reporting mechanism that focuses on the absolute number of tokens burned, rather than the percentage change. The long-term risk is that the current low burn rate becomes the norm, leading to a permanent ceiling on the token's price potential. A balanced opinion on the 3,620% burn rate surge must acknowledge both the technical reality and the community's enthusiasm. The primary risk is the erosion of credibility. When the community celebrates a statistically insignificant event as a major victory, it risks alienating more sophisticated investors who understand the underlying tokenomics. This focus on vanity metrics can distract from the real work needed to drive Shibarium adoption. The cautionary points include the fact that the current burn rate, even with the surge, is not deflationary enough to counteract the natural selling pressure from long-term holders and market fluctuations. The neutral insight, however, is that the community's enthusiasm for the burn is a powerful psychological factor. The desire for scarcity is strong, and this collective focus ensures that the developers remain accountable for the burn mechanism. Furthermore, every token burned, no matter how small, is permanently removed from the supply, which is a net positive. The red flag remains the reliance on percentage reporting from a near-zero base. Ultimately, the event is a reminder that while the Shiba Inu project has a powerful community, it must mature its reporting and focus on the absolute measurable impact of its tokenomic strategy to achieve its long-term goals. So, there you have it. The 3,620% burn rate surge was a statistical illusion, a headline trick that masked the reality of a mere 715,000 tokens destroyed. The SHIB army is passionate, but the math is unforgiving. The real victory won't be a sensational percentage, but a sustained, utility-driven burn that destroys trillions. The question now is, will the community look past the trick and demand the real numbers? We will continue to track the Shibarium velocity and bring you the very latest updates. The day is over now. Remember to give it a big thumbs up. To see our most recent material, share it and subscribe to the channel.